Hi, this is Michael Carlin, President of Henry & Horn Wealth Management, with your second quarter Global Markets Outlook. Today, we are joined by Vice President of Henry & Horn Wealth Management, Stefan Dye. Stefan.
Wonderful to be here.
Good to see you.
Happy to be here.
Excellent. We've got a lot to cover, as always. We've got too many slides, too much data to cover in a half an hour, but why don't we give it our best? I think it'd be a great way to open, Stefan. We were talking a little bit about narrative economics. Do you want to give us a nice overview intro so we can set the stage and dive right in?
I think it's totally fascinating that and everybody knows stories move markets, and there's a new book coming out pretty soon. Professor Robert Shiller, who you know, Michael, I love, is writing a book about narrative economics. There's some great stuff out there by a guy named Ben Hunt, just talking about how markets are driven by stories. Last year, Goldilocks was a story. There was Melt Up that hung around for a while. And now it seems like the big story is the punch bowl narrative. Right. What's the Fed going to do and how's it going to affect the markets? And another one is the trade war narrative. And that these stories really dictate what the writers are writing about and what the people are talking about and how the markets move based on what people are believing about these stories and then the data that comes in. So I think it's great today that we're going to focus on the punch bowl narrative and we're going to focus on the trade war narrative as well.
Yeah, those are the two big components we've got to jump in and tackle. Again, let's just recast this market outlook again for the listeners. What we do all the time throughout the quarter is we're looking at data, research, we are reading, we're writing, we are working hard to try to figure out where the economy is going. So with all that data and all that insight and all that information, oftentimes what we find is a lot of it's noise. A lot of it is authors trying to sell things, and what we're really trying to do is figure out how to best allocate client dollars. And we hope that as we share our research and our due diligence, you're able to better understand what we're doing. You're better able to help, when you're looking at your own situation, forecast where you need to go. And there's no better way to do this than look at the year that was, again, in 2017, and what was the first quarter. This 2017 was miraculous from the standpoint of you could go U.S. large, you could go emerging markets, different types of bonds, high yield, global, you could have done munis, any government bonds, virtually of all kinds, alternatives, the long short guys, Stefan. They all made good money last year.
They all made good money consistently with very little volatility, just climbed and climbed and climbed.
Yeah, and then what did we have? We had a nice couple of good week run in January, and then it was immediately met with some serious volatility. We'll talk a little bit more about this, but what it amounted to in the first quarter of the year, you had U.S.-based large cap stocks losing almost 1%. You have international stocks losing 1.5%. Different types of bonds, high yield down almost 1%. Emerging market bonds down 1.7%. The long short guys were down about 0.5%. And as you look through the first quarter, most things ended up getting punished amidst all this volatility. So interesting to me.
Well, just fascinating. Well, I think in our last podcast, we talked about the low volatility and wondered how long it would continue.
Right.
And I think we were right to think that it wouldn't continue forever. And all of 2017 was strong, and 2018 has started very choppy.
It did. And a big part of it, just as you set the narrative, is the Fed. And the Fed, when we started the beginning of the year, really that end of December, there was the expectation that the Fed was going to bump up and move that short part of the interest rate yield curve higher. And there was a thought that, maybe they'll do a couple of interest rate increases. But now the difference between where the market is handicapping these Fed increases at the beginning of the year to today is significantly different. So much so that by January 2020, the expectation now is that the short-term part of the yield curve, those short-term interest rates, will be as high as 2.5%. At the beginning of the year, was closer to 2%. So again, as the Fed is raising rates, they're pulling back the liquidity. They're making things more expensive for those that borrow. They're making cash a more interesting alternative. And that Fed movement, the market movement with Fed expectations and what the Fed is doing and saying, we had a huge spike in VIX volatility right there in January, as high as we'd seen in some time. And as I look at it, between then and even now, here we are sitting in late April, early May, looking at the market, we're seeing volatility continue with the Fed. So, for me, Stefan, we do need to adjust the way that people are looking at Fed actions. And we do need to start to appreciate a little bit more about what the Fed has done and how that's positively impacted stocks.
Absolutely. And it's not like the Fed has not indicated what it's going to do. It's telling us very clearly. The new Fed chair, Jay Powell, is saying we are going to take away the punch bowl. We are going to raise the rates. Mm-hmm. And the Fed futures is expecting it. The Fed is telling us it's going to happen. And it's already happening. So I think the narrative for the rest of the year is the strongest narrative. The most important narrative for us to follow is this Fed taking away the punch bowl narrative. And we're going to be watching it carefully as we're going to be advising people to follow along with us. Right.
And we're starting to see, if you look at that city, we call it the city, the surprise index. If you're looking across major economies all across the world, you saw a significant drop in this surprise index. And a drop, by the way, is the kind of thing that makes you feel that maybe the future economic data might not quite be as rosy.
Yeah, and for those of you who don't know yet, the Citigroup Economic Surprise Index measures actual economic data against Wall Street estimates, and is really a gauge of economic optimism about the economy. And that Citi index, that economic surprise index, peaked at the end of December and began to fall throughout the quarter. And most indicators expect it will continue to fall. And you'll see stock prices can move up on positive surprises and can move down on negative surprises. And so it's interesting to note that as that gauge peaked and began to fall, volatility began to rise in the stock markets as the expectations now are being disappointed.
And uncertainty goes up. So you got the data going down, uncertainty goes up, uncertainty, the market hates uncertainty. To me, not surprising. To me, it's not a surprising issue.
Right.
As we continue to kind of evolve this economic discussion, we got to turn to inflation. Now, there's a great chart that I saw that I'll highlight, Steph, and I really want if you could take the listeners through your take on the importance of inflation. The chart that I'm thinking of, I know you saw as well, is that it shows that the stocks get the highest PE ratio, or meaning the highest valuation historically, when inflation's running between 2 to 3%. It's kind of, you'll hear this Goldilocks scenario. And we've had this Goldilocks scenario where inflation's running between 2 to 3%, and we have these very handsome, rich valuations for the stock market. So great. It helps explain that low, moderate inflation, helps explain part of the reason why stocks are able to do so well. But if you look, the scales are starting to tip and inflation is creeping up. So the thing that I'm hoping you can take the listeners through is that how do they handicap inflation? Because it's something that people really haven't been thinking much about.
Yeah, I think that's a fascinating chart that you're talking about, and it really showed how when inflation is in a band between 0 and 2% is when stock markets really perform the best. Mm-hmm. And when inflation gets above that kind of 2% level, the markets historically 3% level don't perform quite as well. And when inflation is negative, you see disinflation, right. Markets don't perform as well. So it's an interesting indicator to watch. It also affects people in their ordinary lives. I talk always about how the returns you should pay attention to are inflation-adjusted returns, after fee, after tax, after inflation. Call it returns that you can eat. It's what
and no one does that because that's not a number on a statement. No one ever shows it.
It's not on the statement, and it's far too complicated, but it's what's affecting how your purchasing power is growing or weakening year in, year out. Mm-hmm. Yeah.
Right. And again, if you look at the numbers, if you look at inflation, and let's just say inflation were to average 3%, something like that, then your cost of living is going to double roughly every 20 years.
Right.
So to Stefan's point, if you don't have an investment that's doing a heck of a lot better than that, you're losing money.
Well, I see people who are holding cash in bank accounts at 0.05 and 0.06% in a 2% inflation world.
Right.
That means they're losing about 1.95% of their purchasing power per year, but they believe that they're doing it safely. So you're safely and conservatively losing purchasing
money.
power.
Yes. I mean, you're on a guaranteed basis.
You're guaranteed to lose purchasing power.
Right. And this isn't like to say that cash is bad, because it's not. And we understand the point of having cash, but it's not a great storer of long-term value.
No, it's not. It's a good diversifier. It's good to have dry powder when there are good opportunities to place it, but it's not necessarily a great investment. And on the inflation, I think we talked about the Fed a little bit. The Fed's inflation target is 2%.
Right.
And we're hitting that 2% inflation target now. So what they're seeing is inflation is about where we said we're willing to tolerate it.
Yeah.
We don't want much more than that. We're telling you we're going to raise rates. And if inflation were to accelerate, then you wouldn't be surprised to see the Fed accelerate the rate of withdrawal of the punch bowl.
Right.
Right.
So we need to keep this conversation going on the Fed, because one of the things that we want to break out is that there's this, again, really long run of the stock market performance. It's been fantastic. It's the second longest run in stock market history.
Amazing.
Oh, that's great. So there's something that's called the Great Beta Trade. And the Great Beta Trade is that thing where when the stock market's going up like this, the only thing you really need to do is own stocks, and the market's going up like this. In fact, the more aggressive, the better. And if you look at a chart as we have, and by the way, I should mention that all of the charts and things that Stefan and I are talking about and referring to, you can always send us an email at info@hh-wm.com, and we're happy to shoot out our graphs and charts that we're looking at. There's a chart that shows the S&P 500 index, and right underneath it, or right alongside it, is the Fed balance sheet. And what it shows is that, again, as the financial crisis hit, the Fed expanded their balance sheet. And as the Fed expanded their balance sheet, it provided this level of certainty. It provided a level of stability as the Fed was going out and buying assets, in some cases that no institutions wanted, or in some cases that institutions had to get rid of in order to shore up their own balance sheets. The Fed was that buyer of last resort. And they took their balance sheet to about $4.5 trillion. And if you look at the stock market with the Fed balance sheet, as the Fed balance sheet grows, the stock market rises with it. And if you look, when the Fed started to reduce the holdings, no longer increase the holdings on their balance sheet, the market did go up a little bit, but it's been pretty steady ever since. It really hasn't had that kind of explosive growth. So to ignore the Fed in this kind of environment, and to ignore what the Fed's doing, and to have any hope you'll understand what's going on with the stock market is, in my opinion, a mistake.
Yeah, it couldn't be more clear on this chart. If you could see it, it would be so obvious to you. But I don't know, Michael, was that QE2 or QE3 that started in 2013? I can't remember.
It must have been QE2, right?
I think it was QE2, which is quantitative easing 2. The Fed says we're going to go out and buy a bunch of assets to infuse money into the system. And you can
I want to change QE3. I think it was QE3. QE2, I think, started in 11.
Okay.
Okay, sorry, go ahead.
All right, so we're going with QE3.
Yeah.
You can see right on the chart with QE3, the balance sheet starts to grow and the stock market grows right along with it. Then you see the balance sheet start to flatten really at the beginning of 2015, and we've been choppy ever since. We had a big rise off, then down, and then back up, and down and back up. It's amazing how correlated they look when you look at them.
Yeah, and again, so when you look at the Fed's impact, those low interest rates, it makes it easier for consumers to borrow, makes it easier for businesses to borrow. Again, cheap rates, I mean, cheap rates to buy cars, cheap rates to buy houses. It supports the auto industry, which has had great numbers the past number of years. It supports housing sales, which have been great. We're seeing housing prices similarly on a national scale to where they were back in the year 2006, 2005. So as you look at the Fed's impact of carrying those low rates, it helps so many parts of the U.S. economy. It helped drive things to such a degree. It's no surprise that the market went up, but we need to be especially cautious because the market's going to lose some of its energy to drive forward without the Fed's help and support.
Yeah, we talked a lot this week about Jack Bogle, who's the founder of Vanguard. We're big Vanguard fans, use a number of their funds in our portfolios. And Bogle is famous for a formula for future market returns, which I think is excellent in its simple elegance. And he talks about future market returns equal dividend yield plus earnings growth plus changes in the price to earnings multiple.
Right.
An expanding balance sheet then doesn't necessarily affect dividend yield, but it does affect earning growth. Mm-hmm. The more money in the system, companies earn more money. Historically low interest rates help earnings growth. And then it also increases the multiple, which is just what you're talking about. There's no other alternative, so people buy more stocks. And there's a greater present value of future cash flows in the stock, so people buy them, so the multiple goes up.
Yeah, and so here we are today, and in continuing that conversation on corporate earnings, if again looking at another chart, if you're looking at corporate earnings versus the S&P 500 price movement, as corporate earnings have improved for the S&P 500, so have the share prices. That's not shocking. Not shocking.
Of course.
What's interesting to note is that the 2018 estimated earnings are significantly higher than they are for 2017. And the 2019 earnings are supposed to be better, but not so much better that it's like this massive improvement. So there's some level of acknowledgement that earnings are improving for 2018, much better than 2017. 2019 looking a little bit more hazy. And so there's this chart, and I kind of juxtapose this chart with another, which shows the market going back to 1998. And what it shows is there's the wavy market that goes up, and then you got the dot-com bubble burst, and the market goes down, the market goes up. You got the financial crisis, the market goes down, and you have this very long stock market cycle here. And what it shows is that there are 4 periods on this chart where earnings were expected to continue to increase and didn't. In those 4 periods were the dot-com bubble burst. There was these forward-looking earnings projections that were saying, hey, Stefan, don't worry. If you think, and by 2019 estimates being hazy, what I mean to say there is that they're improving, but not so much better that it's dramatically better. And I want to give these earnings estimates some context. It's important that we start to understand a little bit about earnings expectations and how that factors into the market. One of the charts that I'm holding here takes a view of the stock market going back from 1998 all the way to 2018, the end of the first quarter. What I find interesting is that in this chart, it shows kind of that rolling, the S&P estimates rolling higher, and then in each successive case, going back to the dot-com bubble burst, to the financial crisis, to the flat market of 2015, earnings estimates going into each of those cycles were showing a rosier picture. So what this means is that the analyst estimates, these corporate estimates, the estimates put forth by these companies that are working really hard to project and forecast where their budgets are coming in and their sales and revenues, their expectations, they weren't forecasting things to be worse going into the dot-com bubble bursting. They weren't forecasting things to be worse going into the financial crisis. They weren't forecasting things to be worse with their earnings estimates going into the flat market of 2015. The concern that I have, Stefan, is that in this market right here, all those rosier estimates for 18 and 19 that I was just alluding to, we've got the same style future projection that these future earnings are going to be so much rosier, and then it just gives people, I think, institutional investors should know this better. Retail investors likely don't, but it gives people these future earnings estimates a false sense of security of some kind.
Yeah, absolutely. And I think you've done some great work on this week. I'm really impressed with the chart that you've got there showing what looks like analysts who are forecasting earnings on a straight line. And you don't need a PhD to say earnings have been growing at X% for the last few quarters, and I assume they're going to grow at that same X% for the next few quarters, which is basically what it looks like. But then when earnings start to fall, then you have disappointment, and that's when the markets start to roll over. And you do see right now really high expected earnings growth, just unbelievably high.
And the first quarter, I'm excited to say, it was year over year better than 30% better earnings reports for companies that are publicly traded. That's great.
Incredible.
I'm happy.
Amazing.
But again, let's not get lulled to sleep, to use that again. And I'd point out that strong earnings growth, what that historically means for inflation is that high earnings growth typically means to higher inflation.
Right.
Again, we've been talking about inflation a lot in this podcast. It's worthwhile to bring it up again, but because this rising inflationary pressures, it can tend to lead to Fed tightening, and with Fed tightening, potentially some contraction with stocks.
So exactly right. This is the punch bowl narrative that we're going around and around, but we're going around and around it because I think it's so important. I think it's fascinating to remember that the last 4 times the Fed has tightened, or what we're calling remove the punch bowl from the party, the average change in the price to earnings valuation, the PDE ratio over those last 4 tightening cycles is about 1.7 PE points. It happens every time, the last 4 times. In fact, PEs have actually declined in 8 of the past 8 Fed tightening cycles.
That's a statistical certainty. I mean, again, that's
8 in a row.
It's 8 in a row. I mean, that doesn't mean it's a forever perfect thing, but you got to pay attention to it.
It's a very strong likelihood, and when you look at a chart of where we are, forward S&P price to earnings multiples relative to the Treasury yield as a percent. We're pretty high with the multiples, and we wouldn't be a bit surprised to see those multiples begin to fall at some point.
Right, and we've seen them come down now again in the first quarter because earnings estimates have been so good. You get a higher higher earnings. That ratio comes down.
Right.
That's a good reason for PE to come down, but they've only come down again 0.7. And as Stefan said, 1.7 is the average. So there's still more likely contraction ahead if you've got those inflationary pressures. And as we've been building this case, it seems that over and over and over again, you're looking at all these factors, and higher inflation starts to feel more like a certainty. Yeah. And with those, the higher inflation points, what I would indicate is that we got to talk about the Fed funds expectations, because there's 2 different things. There's one, you've got what the market expects, and 2, you've got what the Fed governors themselves are expecting. And both are expecting by the end of this year, market expectations and the Federal Open Market Committee expectations, the Fed, they're both expecting to be the short-term rate to be right around 2.1%. That's a lot considering the fact we're right around 1.5 today. That's a lot of interest rate increases. It's a lot of movement. Certainly at least another 2. By the end of 2020, though, there's a little divergence. The market's expecting the short-term rate to be 2.6. The Fed's expecting it to be 2.9 and stay there. Again, these are just expectations.
But 2.9, yeah. Michael, maybe just to put an exclamation point on that or underline it, today we're at about 1.5.
Right.
So 2.9 is almost 3, which rhymes with almost double over 2 years.
Yeah.
That's a real movement in the Fed funds rate.
It is, because let's not ignore a couple of facts. If you've got the 10-year Treasury right around 2%, which was what it was in fact less than 2% for some time, and you've got a good quality company like Procter & Gamble that has a yield that's greater than the 10-year Treasury, as an investor, you're thinking, why not buy? No, I'm not going to buy the 10-year Treasury. I'm not going to buy that bond. I'm going to be buying the stock that has a yield that's even greater than the Treasury and can give me some upside. And at the same time, you're thinking, well, I can't put my money in cash because cash forever was earning zero. And then you look today, we have money markets that are yielding 1.7 on the taxable better. We have the tax-free 1.4 plus. So we're starting to see better options for cash. You're starting to see interest rates move higher. So it where the market was this most likely destination for capital, those themes, those narratives are starting to evolve a little bit.
That's right. With interest rates so low, people have been reaching for yield anywhere they can find it and accepting additional risk for that additional yield. So now we're seeing short rates coming up. Right. Why would I think that holding a stock that has risk, that has a dividend yield of 2%, is better than holding a 2-year Treasury obligation that's yielding 2%?
Yeah, you would.
They're not similar in risk.
Right. And so as we look again at all this news, we certainly want to paint the balanced picture. And the balanced picture is that we still are in an economy that is producing good numbers. The first quarter GDP numbers were solid. They're expected to be, by many, somewhere in that. Lots of people are hoping for that magical 3% number. Who knows? We've gotten it. We've printed a number that was greater than 2% for the first quarter. We'll have to see how the rest of the year shapes up. So that's good news. We're also looking at, again, corporate earnings, as we've said they were good, and earnings were so good. If you look at the big U.S. blue chip stocks, the S&P 500, the PE ratio, again, how expensive they were trading right around 20 to December 31st. Today, or the end of the first quarter, I should say, they were trading at 16.9. And the reason why that's important is because that's right at the 20-year average. And you can go down from U.S. big blue chips to international to the different world stocks, the small cap. Each of those PE estimates, those again, the ratio to determine how expensive a particular stock or company is, from where it was at the end of the year to where it was at the end of the first quarter. In each of those numbers, we'll show you the chart. If you email us at info@hh-wm.com, we'll send it to you where you can see we're right at that 20-year median average.
Right at the median. Right at the median, which improved earnings outlook supports the near-term valuation picture. But I want to play devil's advocate here just a little bit, because these are forward earnings. And if you look at earnings going back over the 10 years and you stabilize them over 10 years, you use that what's called the cyclically adjusted price to earnings ratio, my favorite, as you know.
He loves the Cape.
I love the Cape. What it tells is a little bit of a different story. It shows that valuations are at virtually all-time highs. In fact, the only 2 times valuations have been this high, or stocks has been this expensive in the United States, were in 2000, when a bear market followed, and 1929, when a real bear market followed. So from a cyclically adjusted price to earnings ratio, we're very high. But from a forward earnings look, we're right around the median, right in the middle, which goes to what you were just talking about, the work you've done that's so good this week on earnings estimates and how they may be overestimating.
Right, and we know and we appreciate that there was an 8% overall boost to corporate profitability due to tax cuts. Mm-hmm. We see that coming in. That's favorable. But again, as Stefan said, we got to be careful of valuation. And as we look ahead, one of the other areas that I want to make sure we dive into is this flattening yield curve.
Yeah.
Okay. So the yield curve. If you're in your car, if you're listening to this podcast somewhere, you think, well, okay, how can I visualize? I'm going to try to help you visualize what a yield curve looks like. What you would normally think, to yourself that short-term rates, whether they be short-term borrowing rates or short-term rates to have a money market, money fund, it would be lower or less than a long-term rate. Again, a long-term rate, whether it be you're borrowing money or you're giving your money to somebody for a long period of time, you'd expect to get more. So you expect lower rates on the shorter part of this curve, and the longer you go, the higher the rates. You'd expect this kind of positive sloping, this line that gets higher over time in a chart in your mind, and that's a positive sloping yield curve. And that's what you want. It's a sign of a good, healthy, growing economy in most cases. And it's not the most perfect trading symbol, but as we're trying to gather facts, as we're going through the data, it's something that we want people to think about. What's the shape of this yield curve? And the reason why we bring this up, we've talked about the Fed raising the short rates, as they have been. And as it moves that short part of the rate yield curve higher, you're not seeing as much movement in that long part of the curve, those 30-year treasuries, those 10-year treasuries. Yes, they've moved a little bit higher, particularly in the 10-year, but not so much in the 30. So as those haven't moved and the short part has, you're looking at this yield curve getting flatter and flatter and flatter. And if you remember the podcast that we did on interest rates, we talked about if the yield curve gets to where it's 70 basis points, a difference between short and long, it typically means a recession's coming within 18 and 24 months. We are looking at a yield curve that now is at 50 basis points difference between short and long. This is getting very flat. And if the Fed has their way, as we indicated just a few minutes ago, with continuing to raise rates, you can expect the yield curve will get flatter. So why are we mentioning this? The last two business cycles, the one from the dot-com bubble bursting and the other in the financial crisis, happened to coincide with two other flat yield curves. Stefan, I'm concerned.
Yeah, we're still on the narrative about the punch bowl. We're here on interest rates, and one of the biggest risks facing equity investors is recession. And a significant flattening in the yield curve would significantly raise recession risk, and we're seeing it happen. So it's important for equity investors to monitor changes in the yield curve. That's why we're talking about it. Historically, the stock market does well until the yield curve nears inversion. So inversion would be when those short-term rates are higher than the long-term rates that Michael was talking about. So therefore, the challenge for equity investors during the balance of this recovery is remaining appropriately attentive to the yield curve as it nears inversion, but remembering the stock market often does well with a positively sloped yield curve, even as flattening. So historically, during the post-war era, recession and risk associated with a flattening yield curve is less than 20%. However, when the yield curve has inverted, the historic probability of recession within the next 12 months rises to almost 72%.
That's a number.
72%. So currently, even though the slope of the yield curve has declined to 1.1%, which is close to the flattest of this recovery, it's still average by historical standards, suggesting the probability of recession in the next year is only about 4%.
Right.
But we're watching that yield curve carefully, because if it does invert at some point, and it can move quickly, it may move slowly, it may move quickly, but if it does, we'll know that recession's around the corner.
Right.
So we're watching it like a hawk, as you should be too.
So a couple of other facts that we got to dive through, data points we want to just take you through, and then we really am excited to go through our special data set, which is the China tariff. We got to get to that.
Trade war.
So in the interest of time, we've got the S&P 500 that is testing its 200-day moving average. We want to be wary of that. The other thing I wanted to note, and then Stefan, I know you may have a comment or two on the moving average, is that this current job creation cycle that we've been on is just about as long as the one we experienced in the 1990s.
It's amazing.
Right. So creating jobs for so consistently long hasn't happened in many decades. And the reason why it's concerning is because I feel like with numbers that are similarly long to the 1990s dot-com bubble expansion, you feel like you're coming more to the end than you are the beginning. So I don't know if it was whether moving average or the jobs numbers, if you had anything you wanted to add on either.
Well, the beginning of the end is one of the narratives that we're starting to see in the Financial Times, the Wall Street Journal. It's one of the things that the analysts are starting to talk about. I think it's interesting. You're on the payroll expansion numbers. I found it fascinating that initial jobless claims dropped in the first quarter to the lowest level since 1969.
Hey.
1969. It's been that long. And I think
we were single income households at that time, right? I mean, it's a different world.
It was a different world in 1969, and I think the Fed is watching this carefully, and I think this bolsters their case or supports the Fed's case that it's okay to raise rates because things are going so well.
Right.
So many people are employed, jobless claims are dropping. And then on the 200-day moving average, for those of you who don't know what it is, if you look at a chart of stock prices, you can take the average of the last 200 days of prices and draw a line. In an upward sloping market, the line will just be below the prices. Institutional investors watch this line very, very carefully, and it's kind of the marker for whether you're in an uptrend or a downtrend. And interestingly, historically, most of the volatility, the big volatility that you'll see in the stock markets is when the market is below that 200-day moving average. And we're settled right now right on it. And I know institutional investors are watching this carefully. If we were to move strongly below it, I think we'd have a lot more concern. And look, the market direction right now is not clear. We don't know if this uptrend is still continuing, or if we've begun a downtrend, or if we're going to crawl sideways for a while. So we'll be watching that 200-day moving average quite carefully.
The great points. The last data set that I want to make sure we spend a minute covering is the extent to which rates rise. The extent to which rates rise is that it can happen that the 10-year Treasury could move up more than 0.5%. But if you look at the percent of the time that the 10-year Treasury moves even more than 40 basis points, which is less than 0.5%, it happens about 5% of the time, which means 95% of the time the 10-year Treasury doesn't move that much. So I caution people from having this concern that the 10-year Treasuries are going to run like a runaway freight train, because that's just historically not what happens.
Right. And it apparently the 10-year rates are going to move more slowly than the 2-year rates, the short rates, and the Open Market Committee Fed funds rate could move even quicker. We talked about it potentially doubling in 2 years, but the 10-year rates do not appear to move that quickly most of the time.
Right.
Yeah.
And the last is munis, muni bonds, tax-free bonds. What's interesting is that over the next 9 months, the last 9 months of 2018, what's expected is that there's going to be, if you look at the total amount of municipal bonds that are just maturing, coming due, getting called away, versus the number of new municipal bonds being issued, the difference is negative $113 billion. That means there's $113 billion less munis on the market between now and the end of the year. If you add in the factor that it's expected there's about $45 billion of money that's going into the muni market looking for muni bonds, and $113 billion less, it's a good thing for supply and demand. It's one of the things that we like about the municipal bond story. It's not, muni bonds aren't appropriate for everybody, but it presents a potentially interesting opportunity for some.
Yeah, absolutely. The fundamentals that you're describing are fascinating. Provide some real opportunity, provide some real downside protection, and some upside opportunity that you don't necessarily expect in a municipal bond. And I think interesting on the short municipal obligations, you can invest in floating rate obligations, and these are things that will increase your interest rate payment without you having to do anything,
right?
Because the municipality is paying on the obligation an increasing interest rate when rates are rising, which is what we're doing right now.
Right.
Yeah.
I mean, there's a lot of ways to do it, and we could do a whole podcast on that. Okay, so I wish we had special sound effects. Maybe we'll add some
Dun,
about
da-da.
I know the China, like an explosion, like the China trade, or something out of like Kramer's Mad Money. Would be perfect.
We finally made it to
I know.
the special trade war section.
I know, and it's some of you were like, "Listen, I want the trade war. Like we're going to get to the trade war,
Thank
but
you
got
for
to
hanging in there with us.
we got to set the table. We got to set the table. What are we dealing with? Okay, so big picture, China is still the largest percentage of the growth pie in the world. Okay, so of all the growth in the world that's going to be happening with worldwide GDP, China makes up 35% of it.
35.
The U.S. only makes up about 18% of it. And I rounded up.
Wow.
Okay?
Wow.
So most of the growth comes from China. If you look at GDPs, in terms of, again, gross domestic product, what's being produced for each of these countries, the United States, Western Europe, and China are all running virtually neck and neck. Many forecast the day sooner rather than later that China will be the largest, not only part of the growth of worldwide GDP, but they'll also have the largest GDP period. You can see these days coming. That hasn't happened in 200 years.
Yeah, it's been a long time, but China and India were the biggest economies in the world for many centuries, and the Western world has taken them over for a while, but it looks like they're going back. And China is an important part of this story, this trade war story. And what's the overarching narrative here in the trade war story? It's fraying global order, where the U.S. erects trade barriers, others retaliate, trade grinds to a halt or certainly slows, and as globalization reverses from integration to fragmentation.
Right.
And as trade slows, businesses make less money, economies shrink.
So we don't need to say anything more about why this is important. Because that's it. That's it. And that's why this is so important. That's why this has to be the special feature. Because in this trade war, potentially unlocks the key to what we're seeing. And we've seen Chinese numbers, growth numbers, decade by decade. They had years of massive growth, and we're seeing the numbers start to slow as their economy matures.
Right.
Still growing at a clip faster than the United States. Many people are skeptical of Chinese growth numbers, but again, still projected to grow more than the United States. But it's interesting to see as their economy matures, some of the decisions that they make. One of the decisions that they've made is regarding debt. Debt is a big part of what got us into trouble in the financial crisis. Debt is one of the things that tends to cyclically kind of come up over and over again, whether it be consumer debt or business debt or government debt, where it can get you into trouble. And if you look at Chinese shopping and consumption, whether it be what the car companies are doing, the hotels, what they're doing with real estate or agricultural businesses or railroads, and for those that have been to China, they're real clear with me when they come back, but the amount of growth and spending is astronomical. The rate of investment is off the charts. And as a result of that, if you look at Chinese corporate debt as a percentage of GDP, this is the big corporations of China, really, I guess I should say all the corporations of China added up in aggregate, the amount of debt that they're carrying on their balance sheets is 165% debt to GDP, to Chinese GDP. And some people give you some context, that we have a lot of debt here in the United States. We have over $20 trillion of debt here in the U.S., government debt. And you compare that to the size of our economy, and it's about 1 to 1. It's about 100% debt to GDP. So if you think our debt governmentally is a lot, 165% debt to GDP, it's frightening.
Yeah, this is a story that's gets a lot of discussion among hedge fund managers. Kyle Bass is one of the famous global macro hedge fund managers, one of the most famous. He's out of Texas, talks a lot about this. This is his big story, and he believes that this can take down you're going to have massive bank failures in China, and it's going to bring down the world economy in a major way. It's something to pay attention to.
So again, we're not seeing debt issues with governmental borrowing in China. We're not even seeing debt issues, significantly speaking, with regards to household debt. It's really this Chinese corporate debt that starts to get us a little concerned. And now you're folding in with this level of indebtedness. You're looking at a Chinese economy that it's growing less than it was. It's becoming more mature. They're trying to figure out their way with the right economic policies and cultural policies. They've changed some rules about having children, those kinds of things, all in the name of improving life in China in a variety of ways. And you look at the tariffs, and the tariffs have a real potential negative impact on China. I mean, Trump. This purpose of this podcast is not to be political. It's to go through data. And we think ultimately what Trump's trying to do is protect corporate intellectual property. And he doesn't want to have our great ideas that are being produced in the United States being ripped off and being built and recast in China. He sees too much of that. He wants to do something. So these tariffs are a great way in his mind to negotiate, and this negotiation is a dangerous sport, right? I mean, to me, it's if he doesn't do it right, it becomes a zero-sum game.
Well, I think it's odd because the economy is thriving, and a lot of Trump's discussion is about how things are terrible and how we need to erect trade barriers because things are so awful when things are just not awful. We were talking earlier about the Smoot-Hawley Tariff Act of...
Who doesn't talk about the Smoot-Hawley Tariff Act of the 1930s? Everyone.
We laugh about it, and I'll go ahead and share with you just for fun. If you want to, if you remember Ferris Bueller's Day Off, Google or go to YouTube and put in Ferris Bueller Smoot-Hawley Tariff Act, and you'll see about a 2-minute clip that I think is one of the funniest.
It's hilarious. It's straight hilarious.
It's Ben Stein teaching his students economics, and they're falling asleep and slobbering on their desk.
But he hits the right points about this tariff. So, again, put in place, designed to try to protect U.S. interests. And what the net impact was anything but.
It was just the opposite of what they intended. But when Congress passed the Smoot-Hawley Tariff Act in 1930, the Great Depression had already begun. Right. Things were really terrible, and they were looking for ways to increase revenues to the U.S. government and protect American workers. So now we're hearing a lot of the rhetoric about protecting American workers and, saving us from this Great Depression, but we're not in a Great Depression.
Right.
Right.
So you're walking a fine line, because if you look at some of the numbers, and we know that there's that impact because of the Great Depression, where some of these numbers may be, I don't know, a little different, but the U.S. tariff rate was 40%. They took it up to 59%. Our tariff rate was 5%. There's the discussion is to take it to 30%. Again, a lot of the focus seems to be on China, obviously. We seem to be relaxing on Canada and Mexico. The implied rise in prices, this should be eye-opening. In again, the Smoot-Hawley tariff, what that did is it took the average price of goods and services up 13.5%. A proposed tariff of 30% across the board, many expect that to be an implied rise in prices of 25%. We've talked about inflation.
Big number.
But nothing like 25.
Right.
I mean, what is that? It crushes consumption, and as a result, the impact to the United States economy was extraordinarily negative, and it happened at a time that the economy couldn't afford it. And when you add up all those factors, it was disastrous. Now, granted, it occurred during the Great Depression, but Stefan, I mean, it's the kind of thing that to not use this tariff as a negotiation, but to use it as a real tack to increase revenue. I don't know if there's a lot of historical precedents to support that works.
Yeah, well, call me an optimist. I don't think the trade war narrative is going to play out in the most damaging ways for the country. You see people calling it a trade tiff or a trade spat. I think we're more likely to end up looking back on it as a trade tiff. I don't think it's going to be that bad, but when you consider how bad it could be, just in my life, if the costs of goods and services that I consume went up by 25%, that would not be good for my family.
Right.
And if most businesses, business owners, employees of businesses, if they were selling less products because their prices went up, now you've got revenues down, you've got fewer people employed while prices are up 25%. That's just a terrible scenario. I think, as we've been talking, that the more important narrative about what stock markets are going to do has to do with the Fed and the punch bowl. But I think the second one is the trade war narrative that you're talking about, because it's so explosive if it does go the wrong way.
It's that potential black swan, which is something we want to avoid. And so this tariff talk or TIF or however you want to look at it, there have been some small measures proposed about tariffs on steel and aluminum and solar panels, and China responded with some tariffs on luxury foods and different goods, and so it's been going back and forth, and we haven't seen yet the big measures. So to me, the big measures that make this start to feel different would be, and I put, one thing is blocking mergers and acquisitions. Well, oh my gosh, we saw that with Qualcomm.
Right,
they blocked that.
It.
Okay,
yep.
And Qualcomm stock, take a look. The ticker symbol is QCOM. Qualcomm. The stock got crushed when Trump blocked that M&A deal that mergers and acquisitions deal from happening. So we're already seeing that. I thought that would be a potential sign that things were going to get worse. Another thing that to look out for, if things were to get worse, potentially you see the administration, White House, you see Capitol Hill blocking real estate purchases. That would be an eye opener. Because they make up the foreign buyers make up a pretty decent percentage of real estate transactions here in the United States.
Right.
If China responds with saying, you know what, Boeing, we're not going to order your planes, we're going to switch to Airbus. Whoa, that could be something. Or the bigger would be China looking to unload $1 trillion of U.S. treasuries, wreak havoc on our yield curve, wreak havoc on our borrowing costs, wreak havoc with our economy. So for now, as we sit here, until we see some of those other major symbols or signals, I don't know if the trade war is something that is going to escalate, but those to me would be signs for escalation.
I think you're making really good points, and I think we're wise to follow it carefully. And I think it's going to be easy to do because it's going to be in the newspaper for us most every day.
So, as always, that concludes our trade tariff, and that concludes our conversation about the market outlook. Again, big picture here is that as you're going through the I was going to say the newspaper. Oh, as you're going through your daily newsfeed. Sorry, as you're going through your daily newsfeed and you're grabbing your latest research, be sure to be an independent thinker. Understand the motivations for folks that are writing the information that you're putting out there. Are they writing a sensational headline to get you to open and to read it and to talk about it, or is there good data in there to support it? We work hard to try to grab data, read the data, use our experience and expertise to help you understand what's happening, and then ultimately navigate.
Absolutely. Make decisions based on facts, fact-based decisions, evidence-based decisions when there's evidence and facts to be had.
Yes, absolutely. So, and with that, Stefan, it was awesome.
Loved
again.
It. Thank you.
Again, you can always send us an email at info@hh-wm.com. That's it for this Market Outlook. We look forward to seeing you next time at the Managed Funds Podcast. Take care. Material on this program is intended for general information only and should not be taken as specific investment, tax or legal advice. None of the information contained in this broadcast is intended by the host to be a solicitation for sale of any security. Further information is available by contacting Henry & Horn Wealth Management. Securities offered through Independent Financial Group, member of FINRA SIPC. Advisory services offered through Wealth Management LLC, DBA Henry & Horn Wealth Management, a registered investment advisor. Henry & Horn Wealth Management and IFG are separate and unrelated entities. Henry & Horn and Henry & Horn Wealth Management are separate entities, member of FINRA and SIPC.